have been better, and this is mainly on the back of a lower staff cost. The key highlight this time around is the household insecticides as well as the liquid detergent launch. How are you looking at this segment to aid the performance going ahead, taking into consideration the numbers have always been good right now?
Sure. So I think in terms of the quarter performance, firstly, we're quite happy with, in the current environment, the deliveries in terms of volume at a 8% overall UVG and a 5% organic is something in the current context has been good. Profits growing in terms of EBITDA by 16% is something which we're happy about. And the more important piece is the fundamentals under which the profits have been delivered. They have been delivered through a significantly improved mix in terms of geographies and in terms of products. That's been a structural journey in terms of profits. An exciting time in terms of two launches, the launch of the Goodnight Agarbatti and the Fab Liquid. Both are interesting segments. Both are segments in which we have a right to win. And we really look forward to these doing well in the future.
Right. So overall, what's the outlook looking like in terms of FY25 then? And how do you expect to close FY24?
So we should be on track in FY24 in line with the guidance which we've given in terms of sustaining the volume growths at these levels. And again, from a profit improvement, we should be able to sustain the margin expansion in line with our 9 months past record. Going forward, we've spoken about the underlying volume growth aspiration to be closer to the range of double digit. And all actions in terms of launching new products, innovations are in that direction. There is a simplification agenda which we've kind of fleshed out, where we're expanding the profits by around 400 bips. We are somewhere midway in that journey, and various projects to strengthen the profit profile will kind of fall in place as we go along.
Okay. And from a region perspective, where are you seeing the growth coming from?
Yeah. So India and Indonesia, two markets, have been strong over the last couple of quarters, and we do expect those growths to sustain at the levels at which we've been delivering. When we talk of the other overseas markets, primarily Africa and in Latin America, again, in these markets, the underlying volume growths have been positive. We've delivered mid-single digit underlying volume growth at a combined in the portfolio there. We do expect the volume growth to sustain there. There has been some volatility in terms of commodity prices, which has impacted the sales growth, but it has had minimal impact on the profit growth. And we're quite confident that we should be able to grow the EBITDAs at a consolidated absolute level in these geographies also. So that's how we are kind of navigating the business, looking at overall underlying volume growth in India and Indonesia and consolidated absolute EBITDA growth on a total level.
Right. So would it be right to say, Aasif, that, you know, if you have to take FY25 into consideration, the company will be able to sustain that 8 to 9% volume growth, and say the EBITDA should grow in that 15% range led by a sustained margin improvement?
So we didn't get on to giving a guidance at this stage, but our strategy is quite clear. We want to deliver industry-beating underlying volume growth, and various actions, plans, launch of new products are all in the direction of ensuring that we strengthen the underlying volume growth deliveries. Again, on margin expansion, as I said, there are multiple plans to kind of strengthen the margins from here on. And hence, we are quite confident that we should be able to grow the profits ahead of the top line. Yeah. So, and hence margins will kind of expand going forward.
Okay. And overall, you know, if you see in terms of the new segments that you've entered into in this quarter, do you think that is something which will eat up from a margin perspective, taking into consideration that entry is going to be difficult, where you will have to spend on your marketing spends? And if so, for how long do you see that impact happening?
Sure. So we have significantly stepped up the A&P levels in the business. So if you see over the last year and a half, we've actually kind of taken up our overall advertising and promotion spends from the levels of 6.5, 7 to now close to 10%. Those spends are optimal level of spends which we believe for us at this stage, and that should be able to accommodate entry of new products and entry into adjacent categories. So I don't see at an overall level the need for further stepping up investments in A&P. That should allow us to kind of support all the new innovations which we're putting in the market.
Okay, so does this mean basically that we've already seen a P&L in a better shape now? In spite of this kind of a ad spend that you've bumped up, the margins have been holding pretty strong, right? Taking that into consideration, plus the strong cash generation that we are seeing as well, the growth trajectory which is improving for the company across geographies and businesses, all of these are long-term drivers, right? Anything that you think could be a near-term headwind, for example, the currency headwinds that you could face, or what are you factoring in from a negative perspective?
So I think we are conscious of the fact that in some parts of our international business, we will see some currency volatility. But the way we're kind of dealing with it is that we need to be on top of these movements and be conscious that we kind of take the right pricing in some of the geographies and ensure that our profit growth in the geographies sustains the trajectory. That's what we are doing. A lot of the movement or the improvement in profitability and margins has actually been structural. Our fixed cost base has kind of gone down as a percentage of revenue. We've got the benefit of leverage. A very important driver has been on mix, where countries with higher margin, categories with higher margin has been growing much, much faster than the others. And hence, there has been a structural improvement in mix. So when you look at the overall numbers, they've kind of got that benefit of the mix improvement. So we're quite hopeful of sustaining this as we go along.
Right. Right. So that's the management of GCPL clearly indicating the growth path from here on going ahead. In fact, I also spoke to the management of Titan staying with the consumption space. Let's hear them out.
I think after FY22, first 2 years have been going pretty well. Actually, we are ahead of our required CAGR rate, and that gives us confidence that FY27 guidance is intact. And it is more, what we need to do, of course, we are doing, but I think India macro consumption story is also supporting this belief that we should be delivering FY27 2.5x of jewelry revenue.
Right. Ashok, sales in terms of eye care, ethnic wear and perfume, they have been facing challenges this time around. What's the trajectory looking like?
While opportunity is there, but of course, difficult market conditions. And if you look at even Q3, across industries, the behavior of consumer and behavior of segments are very, very different. While we saw jewelry and watches doing extremely well, eye care, fragrances, etc. faced a lot more competition, lot more subdued demand industry-wide. It's not that in eye care we fared what we did. What we believe most of the players have been kind of witnessing that kind of trajectory. But yes, there is a lot more work to do for us going forward, and we are working on that. In fragrances, I think we are expanding our portfolio. There are explosive growth on the lower price band and then the higher price band. And so we are kind of expanding our skin perfume portfolio. We will see some more action in Q4, Q1, and Q2 of the next financial year. So we are hopeful that these businesses also will claim back their rightful growth trajectory.
So that was the management of Titan, absolutely confident of achieving their FY27 guidance as well. But let's quickly slip into a short break. But before that, a quick check in terms of what's happening with the markets as we speak. We're nearly almost at the day's highest levels as we speak right now. If we can just quickly have the Nifty 50 chart on the screens and Bank Nifty. There you go, 1% up move, 21,922, clearly going towards that 22,000 mark in today's day of trade. It's a strong post-budget rally that we are seeing in today's session. Clearly, it's the fiscal discipline that has been given out by the government that is what is supporting the sentiment, because if you see Bank Nifty as well, 0.6% higher. It's come off slightly from the day's highest levels, but continues to trade in the positive. And you have the absence of populism that has been cheered by the markets as well. Let's just quickly pull up broader markets, mid-cap, small-cap, also seeing some smart gains in today's session. The breadth in terms of Nifty 50s as well in favor of the bulls in today's day of trade. If you have to look at the top gainers, let's see what they are, because you have seen names like Power Grid, 6% up move, BPCL, Adani Ports, Hero Moto, ONGC seeing some smart moves, some bit of pressure on Aisha Motors, and this is on the back of the monthly numbers that have come in. HDFC Life is down in trade. Titan is seeing some bit of a correction post numbers, and that's mainly on the back of the slight weakness or the miss in terms of margins that we've seen. Axis Bank as well as the HUL, which are down in trade. But overall, if you see from the broader market perspective as well, NBCC 15%, SJVN 12%, AB Capital, Castrol India, again on the back of earnings, are down up in trade. Paytm under pressure, 20% downtick on Paytm for a second consecutive day. We will get you continued coverage with regards to Paytm as well. Rites is down 5%. We will be speaking to the management as well after the break. But let's quickly slip into a short break. Lots more on the other side. Please stay tuned to NDTV Profit. Welcome back. You're watching Earnings Edge. Rights, that's a stock to focus on the back of earnings. Revenues, 683 crores, a marginal uptick. In terms of profitability, you've seen a dip that has come in there. And on the margin front as well, we've seen a dip this time around. Joining us on the show is Rahul Mithal, CMD at Rights. Rahul, good morning and welcome to the show. The stock is down 4.5%, reacting to the slight weakness we've seen in the numbers this time around. What has led to this?
Good morning. So let's break down the Q3 numbers. So if you see YOY, the revenue has been flat, and the hit on the profit has been about 18 crores. And the main contributor has been the two main challenges which we had been identifying right from about last 3-4 quarters. And that's the contribution of the export, which is a high revenue stream of revenue. So that contributed to a hit of about 25 crores. And the inspection business, which contributed to a hit of about 8 crores. So a total hit of 33 crores. But you see, strategically, the push for increasing our project consultancy to minimize the impact of these two challenges, which saw a YOY growth of 21%. So that's in line with our strategy. And if you see what gives us, what we are happy about is that the strategy that we decided at the beginning of the FY to counter these two challenges. So if you see sequentially, we are moving in the right direction, consolidating our position. And sequentially, quarter to quarter, all 5 parameters have seen an uptick. The revenue has gone up by 20%. The EBITDA has gone up by about 30%. Profits have gone up. The margin has gone up by about 2%. And we are moving in the right direction.
Rahul, for the benefit of the investors and the viewers then, if you're looking at a sequential growth right now, how are you expected to end FY24? And how is FY25 expected to look like, taking the order book, etc., into consideration?
You see, the three key elements of our strategy for this FY was first to break that, thing about not getting an export order. So we managed to, that was a big gain for us. We got the first export order of about 300 crores for 10 locomotives to Mozambique, and that should start generating revenue in the coming year. The second key area was to grow in the project consultancy wing on an aggressive manner. So that has been growing sequentially. We're reaching an all-time high figures in project consultancy. Even Q2 to Q3 has seen a growth of about 5% in project consultancy. And the third key element was to keep on aggressively bidding both domestic and international and getting more and more orders across all my consultancy verticals. And we had aimed, if you remember, at the beginning of the FY to become a 1 order a day company. We were in the range of 0.85, then 0.87. And this quarter 3, we are proud to say that we've become a 1 order a day company. We've got 100 plus orders totaling to 600 plus crores. So now we can proudly say we are a 1 order a day company. So with these orders coming across verticals and this export order also coming up, our aim will be to consolidate this FY, reach as close to the previous FY levels, and moving forward next FY to have a steady double-digit growth in our profits.
So, with regards to the change in strategy as well, Rahul, how are you looking at, specifically the business to perform from here on now with regards to where exports is concerned? And apart from that, if you see in terms of even the Q&A business, how is the consultancy business, how is that expected? What contribution are you expecting from there?
You see, both these streams of business were traditionally high margin business, high margin revenue streams. And that's why the margins, and not only in these two streams, across all my sectors of revenue, all infrastructure sectors, and more bids are coming on the competitive mode. And we are getting a lot of, winning a lot of bids on the competitive mode. The margins definitely are more difficult to maintain in the range of EBITDA margins of 28-29%, which were there historically. However, having said that, since now our order book is growing at the pace at which you're seeing, including now this export order will start generating revenue from next FY, our goal would be that while we would try and secure margins at an appreciable level. But realistically speaking, the aim would be to have a growth in the EBITDA and the absolute profits, a healthy double-digit growth over my baseline of the FY 22-23.
Right, so this is going to be an interesting move from here on. Rahul, we are completely out of time in this edition, but we will touch base with you once again to do a detailed conversation with regards to the new strategies that you're planning. So that's the management of rights. Sequential good growth, but pressure in terms of a year-on-year basis, in terms of a change in business mix, and that's what is putting pressure on the stock. But now let's head across to Rashesh Shah, chairman of Edelweiss. My colleague Muralidhar Swaminathan is in conversation with him to talk about his key takeaways, from the budget and what it means to not have any populist measures in contrary to the general expectations ahead of the budget. Let's hear them out.
This year, I think this government has been very, very, very pragmatic. I think amongst, because all governments have to make the trade-off between spending money and not allowing inflation to be run away. We have had a big bout of inflation all over the world in the last few years. We had COVID also. But all through this, I think one of the hallmarks of this government's approach has been the fiscal prudence. They've been balanced. It's not that they have not done programs and social schemes and all of that. But they've been very balanced. And I think balance is very important. It's not whether you should spend or you should not spend. Is it, can you do it in a balanced way where the conflicting needs of the economy are also being met in a very pragmatic way? And that is because I think inflation is a very, it's an emotional issue, it's a political issue, it's a social issue. It's not just a financial and economic issue. It's a very big issue in India, especially inflation. So this government, because ultimately fiscal prudence is about inflation. It is not about anything else. You allow it to go away, a couple of years down the line, inflation will come back to haunt you. So this government has been very careful, and that is, I think, full marks to them for through hard times, through COVID and all, also the fiscal prudence, where many governments all over the world, they injected stimulus and they spend money. This government has been very careful. They gave guarantee schemes, they give credit guarantee, they did other ways of providing support to the economy, but they've been very creative, as you said, very innovative in their approach to provide stimulus without allowing the fiscal discipline to run amok. Because once you go down the fiscal discipline running amok, it's a slippery slope, because there are always a lot more things you have to spend money on. But this government has been very careful. I think what they are currently targeting, I think anywhere between 5 to 5.2, 5.3 is a good number. Even the nominal growth they're expecting is only 10.5%, which I think is low. I think we might end up with more than 11 to 11.5%.
They have the potential
growth. So I think there is a little bit of room on the upside. The government has not used up all the ammo. And I think it's the fact that they're going to reduce the borrowing from expectation itself is good for the bond markets also. I think credit conditions will improve, credit availability will improve for the private sector, which is required, because if you are depending on capex, and if the government borrowing is very high, then the private sector will not be able to borrow.
It'll crowd out.
So I think the crowding out will not happen in this year. In fact, we might have more capital available than the spenders for that in this year.
Which could also come in the form of inflows after the JP Morgan bond index.
Yeah, I think the inflows from abroad plus our own household savings, though they have, as a percentage of GDP, they have come down. But our GDP is $4 trillion. Household savings should be about close to $1 trillion in the coming year. So we have a lot of the local savings available. Plus we have the inflows via FDI, via FPI, via the inward remittances, and now with the bond inflows also coming in, I think we're going to have a problem of surplus capital in the coming year. And I do hope that that surplus capital is used by the private sector for reviving the capex.
Right. I underlined one statement of the finance minister while she was speaking. She said that, look, we want to be a Vikasit Bharat, developed economy, and wait till July. We will set the roadmap. So it just passed while she was speaking. Now, I think election results is kind of given as far as the existing political establishment is concerned, and maybe they are conserving the ammo for June, July. But the bigger question, underlying question in the economy is that growth is very good, intentions are very good, but then it's being driven by infrastructure and consumption. But I guess that is not enough for us to go there. Manufacturing is still lagging. Exports are still not taking off in a big way. What's your view on those two areas?
So I think India, on all these counts, is an economy where I feel the glass is always going to be half full and half empty. We are the leader in the services. Also,
and welcome. You're watching Earnings Edge with NDTV Profit. I am Mahima Vachrajani. Well, V-Guard is in focus on the backs of Q3 earnings, and we have with us Mr. V. Ramchandran, Chief Operating Officers of V-Guard Industry, to guide us through how the quarter has gone by and what will be the forward outlook of the company. Mr. Ramchandran, congratulations firstly on the strong set of numbers, strong numbers with reference to both profitability and margins. My first question to you is that cash flow from operations has seen a slight decline in terms of 9 months FY24 versus 9 month FY23, despite the increase in revenues. Can you tell us what is the reason behind this?
No, I think, we've had, capex outflows as, we've been, expanding our manufacturing footprint. Yeah. I think we've also topped up some investment in Gigadyne. Yeah. And so I think that's fundamentally. I think last year we had a very strong inflow as the inventory cycle corrected, right? So relative to last year, that benefit is relatively lower in the current year. So, but I think I think these I would say are the primary factors, right? So.
Okay. And with reference to revenue and EBITDA growth, is it volume-led growth or it is a price action-led growth? Like, have you increased prices for some of your...
It's primarily volume-led growth. I think it's primarily volume-led growth. Some mix benefit has flown through, but it's primarily volume-led growth. Yeah.
All right. And on Sunflame, given how the quarters have gone by, I think you had given a guidance of rupees 330 to 350 crores top line with 11 to 12% operating margins for this full year. Do you think this is still possible?
So I think what has happened is, I think since the time that we initially talked about the Sunflame business, right? The broader kitchen industry had seen a slowdown, and I'm sure you would have witnessed this in all the kitchen players also across, right? The good thing is